Hello and welcome back. I'm Natalie MacDonald and you're watching Dukascopy TV. Joining me next in the studio, I've got Daniel Varela of Piguet, Galland and C. Daniel, thank you very much for coming back into the studio with us today.
Hello, Natalie.
Now, we're still talking about that ECB decision. If we consider bond and stock market response to ECB policy, would these indicators suggest that June's meeting action could be sufficient to creating growth?
Well, we have to say that reaction of financial markets have been very good at first. During the first week after the decision, we've seen that stock markets, European stock markets, did react very well. Recently, we see that these European equities markets have some second thoughts, and they find some trouble. And we see that they are underperforming US equities. More interesting is the reaction of the bond market. In fact, we see that very recently, yesterday, we touched a new low in bond yields, 10-year bond yields at 126, which is very close to the lowest level that we have seen during the crisis. So this might indicate that bond investors are not so sure that recent measures announced by the ECB will be enough to stimulate growth and escape some kind of Japanese deflation scenario.
With ECB and Fed policy really starting to move in different directions, how are investors looking to exploit this? Are you noting a change in strategy, perhaps?
Not at this time, but because probably we can't say at this time that they are on different paths. In fact, even if the Fed is tapering, in fact, buying less securities for the last months, and it will continue to do so in the future months, the Fed is still continuing to print money at this time. But next year, probably the Fed would have stopped to buy securities, and at the same time, it might start increasing rates. So next year, probably we will have definitely the Fed and the ECB, which might be doing some QE at that time, moving in opposite directions. The result will be probably some opportunities for the European equities to outperform US equities, and at the same time, probably a period of US dollar strength. So probably we will see at that time investors increasing their allocation to European equities and probably to the dollar.
It's been thought that emerging markets could in fact have the most to gain should Draghi take that route to easy money and implement QE. Can you expand on this school of thought for us a little bit?
So I'm not so sure about this argument. I think short term we might say yes. Why? Because the ECB clearly, with its recent moves, is announcing that they will do some QE. So probably they will increase global liquidity. And we know that in the past, when global liquidity increases, some of this liquidity finds its way towards emerging markets. So this is good. Secondly, probably by having the assurance that we will have very low rates, zero rates in euros for a very long period, that might create some carry trades, what we call carry trades, which means that we have some investors borrowing money at very low rates in euros to put that to work, invest that money in emerging markets currencies at higher rates. So this is also positive on the short term. On the medium term and long term, if the ECB is successful in its policies, we might see US dollar appreciating versus the euro. And we know from the past that emerging markets haven't performed that well during US dollar strength periods.
As investors then are going on that push really for slightly riskier assets, how do you balance this out within an investment portfolio? And what is or could be sort of the post-ECB safe haven in your view?
So that's sure this context of very low inflation around the world, growth coming back, and also very accommodative policies is positive for risky assets. But this phenomenon has already started a few years ago. And in fact, what we see is that in fixed income markets, riskier segments of the fixed income markets, we see that risk premiums are very low already. So probably the asset that will benefit the most from this new policies of the ECB will be equities. If we think about safe havens, if the ECB and other central banks are successful bringing back growth around the world and bringing back some inflation around the world, so probably bond markets around the world are at risk, and you might lose some money even on bond markets. So probably right now, the real safe haven asset is cash. So keep some cash in your portfolios, keep some cash in the bank.
Daniel, thank you very much for coming in and chatting with us today. Thank you.
Thank you.
That's all we've got time for right now, but do stay tuned to Dukascopy TV for plenty more FX insights and analysis. Goodbye for now.